All right, so should be live here. We'll give it just a few seconds to make sure we're good. So we should be good.
Yeah.
Looks like we're 7 o'clock on the dot, right?
Yeah, and I am going to check the site to ensure that we're good on here. Let me go ahead and log in.
Sure.
And those of you who are tuning in, we do truly appreciate your time. And today or tonight, specifically, depending on what time zone you're in, we're going to give everyone an overview of the project.
Yeah. So let's see here. We'd recommend that you view this at our site, holdfolio.com/webinar. There, you're going to be able to actually submit your questions live. We're going to get those questions at the end of this. We're going to address all of those questions. Our target timing for this is about 1 hour. So yeah, let's go ahead and get right into this. Huh?
Yeah, everything seems to be working fine. And again, for everyone that is on holdfolio.com/webinar, you can just submit your questions just right below, and we'll address those at the Q&A at the end.
Excellent. Well, this is a look here at Bentwood Apartments in Louisville. And go ahead and get right into this. My name is Jacob Blackett. I am the CEO currently. Responsibilities include operations, acquisitions, development, and finance. We recently brought on a COO. We're very excited about this, taking control of our property management and spearheading that. Sterling, right?
Yeah, she oversees the operations side and the management, as Jacob alluded to, the property management. And here in Indianapolis, which we'll touch on a little bit later, is she's going to be overseeing the third-party property management company. And I myself I am one of the principals at Holdfolio, and my responsibilities include the marketing, branding, as well as development and the acquisition side. So just a little bit of track record for everyone is our current assets under management is valued over 10 million. You can see the other points as well. We have the management experience of over 1,000 units. To date, we have invested with us, and that includes equity as well as debt too, 6.6 million with the company. We've paid to date to our partners over 978,000 in terms of the rental income to our partners. And our acquisition history is over 600 single family transactions and over 176 multifamily units. So just an overview on the asset in itself is it is a 80 unit apartment complex. It has two buildings that the apartment units sit in. It is built in 1972, and the asset is located on the south end of Louisville, Kentucky. And what we really like about this asset going in is that there is tremendous upside, of course, through our implementation of a value add strategy. And in terms of the highlights, the comparable support, us being able to increase those rents between $93 to $140 per unit. The financing that we have is very favorable. It's a 7-year term, 2 years IO. Yes, that is 2 years interest only with no prepayment penalty. For all of you who have read over, of course, the investment documents, the total offering size is 1.06 million. And it will be a co-investment by Holdfolio as well. So we will be partnering alongside you guys. And then the acquisition per unit is 28,000. Well, just a little over 28,000. And then after reposition, we expect the valuation of that per unit to be 45,000.
So just some of the investment benefits here. We do project some good, strong cash flow out of this property. Out of the gate, occupancy is low. It's poorly managed, definitely in need of what we're doing here. And so once we get that property stabilized, we have some good cash flow, 9 to 11% through the first 7 years. At the end of the 7th year, we went ahead and projected a refinance rather than selling the property. Based on the capital that you have left in the deal, you're going to be earning approximately 57% plus IRR or cash on cash return. And in that 200% cash on cash return, that's getting close to a full return of your capital. So very well, potentially in the seventh year, you'll be getting a full return of capital. And of course, you retain your ownership in that scenario. We have some great tax benefits on this asset. Approximately 70 to 80% of the income you collect will be tax shielded from depreciation write-off. And like Sterling alluded to earlier, we have some good loan terms. A regional bank, First Financial Bank, actually, that we've worked with previously, has offered 70% loan to value, including a $550,000 line of credit for improvements. Interest only for the first 2 years, a 30-year amortization on a 7-year term loan, and we'll have those interest rate fixed as well.
And one thing I want to restate to everyone, if you do have questions, do not hesitate. There is a form just below this video that says submit your questions live. When you submit those will go directly to us. And during the Q&A session after this, we'll address all the questions that come in.
Yeah, and so how we set this up is we have two models when we put together our projections, Model A and Model B. Model A is what we believe is our all-day, quote-unquote, scenario. So in this scenario, we're increasing the rent by $80 per unit. We're also going to implement a utility chargeback of $23 per unit. We'll, in both scenarios, complete $1,050,000 in improvements, and those details are all listed out where that capital is going. Another big difference between these two models is the reposition timeline. So our property manager is targeting and feels pretty good about a 6-month timeline. So we went ahead and projected a 9-month timeline in one scenario and a 7-month timeline in the other scenario. Model B also has some higher rent increases as well compared to Model A.
So our overall investment plan is firstly to acquire the deal, which is set October 11th. And then the other metrics are to implement management systems. As Jacob alluded to earlier, it is extremely mismanaged. Love the individuals who are managing it, but that's something that we plan to implement. The third is to implement chargebacks in terms of the utilities. Our goal is to increase the occupancy to over 90% by July of 2019, which the current third-party management company is feeling very comfortable with hitting that specific.
Yeah, I think he was saying by May.
But let's be conservative. We're going to be conservative. And then to renovate those vacant units that are currently down, and then increase the remaining to market. So a little bit additionally on the management side is it will be managed by AllTrade, which is an experienced company that is based in Louisville, Kentucky. And when it comes to managing, we'll be overseeing that entire process from our headquarters here in Indianapolis. And primarily will be through our Chief Operating Officer, Vanessa, who does have that extensive process working as a regional, correct, Jacob?
Yeah, she was previously had a few thousand units that she was responsible for as a regional manager. So we're excited about her position to be managing the manager. I'm sure people are familiar with that term.
And additionally, with our in-house experience, we have just a little over 300 units that we own and manage at this present time, with our team members 10 full-time.
Yeah. So AllTrade Property Management, like we alluded to here, it's based and founded in Louisville. They have over 4,300 units under management, so they're operating at scale, and we're looking forward to taking advantage of that. They came highly recommended through referrals. Sterling, I think you had found Josh, right?
Yeah, so one thing on the acquisition side saw a common thread that all these apartments were managed by AllTrade Property Management. So one, that was a good sign, but also other operators that were in that specific submarket did recommend Josh as someone to oversee our not only the renovations and the reposition process, but also to manage it through the course of that as well.
Yeah, and it's been great working with Josh and his company so far. They've helped us out a lot of the process through the due diligence and collecting different documents and pro formas and just all the different inspections and getting construction bids. It's been good. So we're looking forward based on the good referrals and experience that we've had with them so far to that relationship.
So an overview on the market as a whole, we love Louisville. Not only is it just less than a 2-hour drive, so that's very great. That's very beneficial from Indianapolis, where our headquarters is. It's just a simple drive to that market. So the population, the MSA, is just under 1.3 million. It is the largest city within Kentucky. And then on the macro level, the population has been on a steady growth. The cost of living is lower than the national average. And then one thing that we've also been able to get from not only our property management company and other local investors is it is very landlord friendly overall.
Nice. So Okolona is what the suburb is. It's about 15 minutes south of downtown Louisville. It's actually home to one of the city's largest shopping areas. When we were down there and on some of our first visits, we were really pleasantly surprised with how much retail and all the different amenities and outlets right there, grocery stores.
Starbucks is always a big one.
Yeah, there's a whole slew within maybe a 10-15 minute walk of the property. So that's great. The area also has the lowest crime in Jefferson County, which is the county servicing Louisville City. Our average monthly rents in Okolona is $828 per month. So what we'll go ahead and do here with that overview is open this up to question and answers. I will mention that you won't find the investment open on our website any longer because we have fully subscribed. So we have full subscriptions. We have a wait list. And so, but yeah, please go ahead and submit some questions and we'll get right to it.
Yeah. And again, the questions can be submitted just under the video. You'll see submit your questions live, and those will come directly to us and we will address them. So a couple of questions that are already in here is one asked by Robert. What process did you use to ensure your rehab cost estimates were accurate, and how did you calculate the amount to hold as contingency?
I'm sorry, I was actually reading another one. I thought you were taking that one. So what was the question, sir?
Yeah, the first initial question was by Robert. What process did you use to ensure your rehab cost estimates were accurate, and how did you calculate the amount to hold as contingency? I can answer the first half of the question.
No, yeah. So we're really leveraging All Trade Property Management. They're operating at scale down in the Louisville market. They act as a general contractor, and so we spent weeks getting different bids and pricing out, along with our own experience. We've ourselves went ahead and completed millions of dollars of construction, so we're very familiar with costs. And yeah, that's, I think, addresses that question. It really comes down to what our budget is at now, which is $1,050,000, and we'll be targeting what we'll be targeting is just a little under $1 million on the project. So our ideal scenario is that we can go ahead and return some of that capital to our partners when all is said and done.
Okay, and the next question that came in by Robert as well is, I wasn't able to find where you listed current rents in comparison to market rents of stabilized properties. What rents did you use to project your financials on this property? So we use several nearby comparable assets, and what we saw was that the rent per square footage was between 90 cents to $1, which is very attractive, especially for this specific older asset class. And current market rents at Bentwood apartments are 79 cents. So with that being said, what we mentioned a little bit earlier is the rent bumps we're expecting between $93 per unit, between $93 and 140. And again, that's supported by nearby assets, which you can find in the property summary sheet that is with the investment.
Yeah, the one here is what is the required length of the investment? How much rehab is required to get the property up to speed? Will you provide all of the financials? And so all of the financials are absolutely provided in great detail. In terms of the required length of the investment, we are focused on long-term investments. So we project a 3-year and a 5-year sale and a 7-year refinance. Our ideal scenario is that we can go ahead and return the majority, if not all, of the capital to our partners from a refinance event so that we can all continue to own and operate that property and enjoy the benefits of owning that real estate. But of course, real estate we will sell at a certain point. We just want to make sure that's on our terms and our timing, especially in terms of the market.
Okay. I want to go up. Another question was relating to how is the crime at the property? Any recent ones? And there's been no major reported crimes on this specific on Bentwood Apartments. And then in addition to that, truly it conveys that Oklahoma does have, as Jacob mentioned a little bit earlier, low crime in terms of relative to Jefferson County.
Yeah. We have a question here regarding it says you say the place has been poorly managed and that's why it has such a high vacancy rate. Can you expand a little bit on what exactly is going on there? Yeah, it's hard to imagine the 45% vacancy currently in place. And what's going on there is that the current owner is well aged. They've owned it for almost 40 years, and the son is managing the property on behalf of the father. Sterling, you probably have some more context as well, right?
Yeah, and that's the current owner owns it free and clear, and he has gone through several managers at this present time, and just went to his son to say, "Hey, could you manage this for me? I own it free and clear," and he's at this moment earning a little bit of cash flow, but since he owns it free and clear, it's just a little bit of some cash that goes into his pocket, but through the
Yeah, I think what we've seen based on our walkthroughs as well is that they're not spending the money that needs to be spent. When a unit moves out, they're just leaving it if it's anything more than a clean. So maybe if you got to replace some carpet or do something more than just clean it, they're not doing that. So I think just that overall lack and they're not motivated, especially being in an all cash position. So I have another question here regarding the waitlist process. It's asking about reducing subscriptions to open up the investment to more investors. By how much? Okay, so we took investments on a first come first serve basis. Our average investment right now is about $35,000 across all investments. So we don't have necessarily just a handful of big fish taking up all the space. We are oversubscribed right now by about 150,000. And so that constitutes about 7 people on that wait list. And so we'll definitely find out if you're on that wait list. We'll find out here within the next few days if there will be an opportunity to step up and invest with us.
I'll go ahead and address the next one after this one. So there's a question by Jonathan that asked about the will this be your first time investing in an apartment complex? No, this will be our fourth investment in a asset of this nature. Before we have a 46 unit that we own and manage, as well as a 50 unit and another 80 unit that's here in Indianapolis, Indiana. And in terms of, it says if you're working with any mentors or team members that have prior experience with apartments. So my partner and I, Jacob, do have well over the experience of managing over 1,000 units with working with other operators, in addition to the person our chief operating officer has. What was it? A little over around the same in terms of units under management?
Yeah, just about 3,000.
Okay. And in the management company that we will be utilizing to oversee that whole process on the management side has over 4,300 underneath their management. So there's an extent in terms of the unit count across the board. And then another one says the FEMA says has this complex experience flooding in the past? Are there any plans to mitigate the flood risk?
Yeah, actually, it is just barely on the cusp of the flood zone. So we do have flood insurance in place. Over the last 40 years of ownership, the current owner has never experienced flooding. We are taking in the scope of work, we are doing some stormwater mitigation to go ahead and put sump pumps in, as well as doing some regrading and work to those crawl spaces to go ahead and try to mitigate any moisture damage over the long term. There's a question here that I'll address regarding the scope of work again, how the scope of work budget was calculated. And so that was in collaboration with All Trade Property Management. That process included a full day where using software, we went ahead and very detailed took notes of each unit from a unit by unit standpoint in terms of current condition and what repairs will need to be made, as well as all of the exterior items. And so once we had that list from All Trade and third party inspector, then we were able to work on consolidating that and putting numbers and getting any bids on items that we're unsure of.
Did you want to get that one? I get the next one, or we could just jump right? Yeah. So the next question is, you may have answered this earlier. Not sure how I believe that's supposed to be 1 million. So the 1.06 million is being used. One part of the offering says it's being paid towards improvements and other down payment. If so, this.
There is a on the financials, the first page, there's an allocation of funds. So it'll break down that 1,060,000 exactly. So roughly, 675,000 is going towards a purchase loan down payment, 22,000 for loan costs, 67,000 on acquisition, another 60,000 for other closing costs, legal, offering. There's a couple $100,000 for improvements and $26,000 as an operating reserve. We are also have a $550,000 line of credit for improvements, and we're also receiving a $300,000 closing at credit for repairs. So that's where that equity for repairs is going to be coming from.
Okay, and the next question says, and we alluded to this a little bit earlier, says, your experience has been primarily running single family houses, at least when you started. How many other big apartment buildings you are managing now? So I'll address that. Firstly is we currently have we have 176 multifamily units under management, and that's comprised of 3 assets. So a 46 unit, a 50 unit, and an 80 unit. And also that will we be highly involved? Yes, we will. and that will be our Chief Operating Officer, Vanessa Turner, who does have extensive experience previously as a regional overseeing apartments in different markets.
Yeah, and we had a question here regarding that management, our experience with some of our apartments. We do have other value add apartments that we're managing directly. And we went ahead and brought Vanessa Turner on board in-house for a very specific and strategic reason. And that's to build a great management company. And so in the past, we have struggled at this point. Management is it's not a simple thing, but once you get the right people in place, you can really have a great thing going. And so that's why we strategically brought on Vanessa Turner to really elevate our whole management. And so related to our timeline in terms of getting this property repositioned within 90 days, or I'm sorry, within 9 months, that really comes from the confidence of All Trade management and the confidence in Vanessa Turner in terms of setting realistic expectations, which of course they're thinking 6 months is more of a realistic expectation.
Gotcha. And one is someone would like a breakdown. I'm gonna earlier question way up.
They don't see
that. Okay. And so it is breakdown of where companies or industries where are the renters coming from? So the property is located near a major highway and of course just a little under 15 minutes to downtown Louisville. So this is a working class setting, or a working class demographic. So it'll be a mix of factory workers, grocery, local businesses, etc. So blue collar type renter base.
Yeah, we have a question about the wait list. So that is not open right now for any more to add to that wait list. We're pretty confident in where we are now that we'll go ahead and within the next few days have solid commitments and be moving forward. But if anything changes, we'll most certainly be reaching out, especially to anyone who had made reservations. We'll be keeping that dialogue to, if there is any investment opportunity here.
So we have, is there any
additional liability being taken on with the deferred maintenance? That's one of the biggest risks in this project is those capital improvements and deferred maintenance. What we've done is we've done a great job of identifying exactly what needs to be done. And so we've been working on this project for probably 2 months on those capital improvements. So this is not something that 2 weeks ago we got an inspection report and we put some numbers down on a spreadsheet. So we've been working on this for over 2 months directly with All Trade, directly with the vendors who will be doing these repairs. So yeah, that's a big risk. Both myself, lenders, All Trade, other vendors, we have a pretty good handle on the deferred maintenance that is going to be coming at us.
So I'll go ahead and answer this one. As the first investment outside of Indianapolis, is that a concern given local knowledge was your strength? And what we mentioned a little bit earlier, we will be relying on that third-party management company that does have extensive experience in the Louisville market, in addition to our Chief Operating Officer, Vanessa Turner, who has experience as a regional manager of assets in various markets.
Yeah, another question regarding market conditions and changing. Market conditions can change dramatically in even less than 7 years. What's the worst case scenario for exit refi and cap rate? 8% could potentially be low in 7 years. What do you think? I completely agree. We went ahead and stress test the occupancy and interest rates. And so we could have also provided some more scenarios on those exit strategies and refinance scenarios. by all means, and maybe we'll take that into consideration for future deals. But we do have that stress test of the occupancy and those interest rates in the financials.
So the next question, and we do definitely appreciate all the incoming questions that are coming in. So thank you all for that. And this next one is by Ahmed, and it asks specifically, does the town, specifically neighborhood, have any major plans for the area in the overall setting? And at this moment, there is no overarching plans in terms on the development side. But what I have seen from my research, our initial research, is there is quite a bit of additional amenities that are coming in. And as earlier that we discussed, it does have that large shopping center and also those other local businesses as well. So that's what we see in terms of steady businesses coming in, ultimately leading to a wider variety of tenants that we can have come to our specific property for renters.
Question here is, you mentioned adding a gym and playground to the property. Will these or other features and upgrades you plan to add help the property stand out relative to other apartments in the area, or make it up to par with nearby properties? It's a great question. There are some properties in the immediate area that once we install that fitness center and the playground and the grill area, along with all of the updates we'll be doing to the property, we will be a standout property within the quarter mile to half mile radius. There's 2 other properties that are repositioned to that standard, right, Sterling?
Mm-hmm. Just nearby.
Yeah, in that immediate area. So we'll be one of 2 other properties that are repositioned to those standards. Everything else would be equivalent or less to those standards.
And one thing from the research and also coordinating with All Trade, who manages assets in that nearby proximity, is there is a significant undersupply of upgraded units in that specific setting. So from his standpoint, once we do get these up and running, it will not be an issue to get those filled by quality tenants.
Yeah. There's a question about the 3% construction management fee, and that's being paid to compensate our team and vendors that will be heading down to the Louisville market, and all the time and attention to detail that will be taken. So yeah, that's just extra time on this deal rather than purchasing a stabilized asset where you're just walking into cash flow on day one. That's just to help offset the additional time that it will take and human resources to get through that project. So with another question is, with the reposition, how much do you expect it to affect its its assessed value with the county and the subsequent property taxes? So the county will be most likely, in what we have in our pro forma is reassessing the property based on our purchase. And so we went ahead and expected those property taxes to increase. Now, in terms of increasing those taxes based on improvements, I've never heard that, especially in our markets that we operate in. I think it's a good point, but typically those assessors are going to be looking at arm's length transactions and comparables, not necessarily looking at improvements and condition.
So we have a next question that asks about shining light on the contractor who will be performing the construction, and do they have an in-house team or subcontract everything out? So it will be a variety. The company All Trade is licensed when it comes to on the construction side, so they will be doing a significant significant amount of the construction, but also when it comes to specific trades, correct, Josh, such as electrical, maybe some of the roofing, that will be subbed out.
Yeah, absolutely. It's definitely a team sport, especially with the big improvement. They have scale with where they're at, but they also will use third-party vendors.
Yeah.
The one question here is that it says, I noticed the last offering had an 8% preferred return, where this one does not. I'm wondering what differs between that deal and this one to not include a preferred return. The big difference here is that this property, Bentwood Apartments, because of the low occupancy going into this property, it just doesn't sustain an 8% preferred return in the first year. We also liked, upon reflecting on the opportunity to just go straight equity, we liked the simplicity of that structure. In addition, investors with that straight equity have more upside on the deal. And yeah, so that's just some feedback on that.
Yeah, so this next question is by Christopher, and it is a great one. It asks about, do we intend to rebrand the property like we've done with our previous acquisitions? And he says, due to the high vacancy, deferred maintenance, is there a negative perception or perspective in the neighborhood? I would say when you Google specifically Bentwood Apartments, and then also speaking with locals, there's not specifically a bad stigma associated with the property. And overall, we plan to keep it Bentwood Apartments, but of course, do a lot of the exterior upgrades to really give it a curb appeal on that side.
Question here is, can you share what percentage of your investors for this property are returning investor? A returning investor means investor who's invested with you in other properties. So as of right now, we have just about 35% of those invested with us are returning investors. Historically, that's typically what it's at.
And we've got one here by Kumar. Can you confirm, understand the 60-40 clause after capital is returned and the sale is 70-30? Is there a preferred return that comes into play?
Yeah. You don't want to jump into that financial related question.
We'll be here all night.
So the deal here is that it's an 88-12 split. So 88% of cash flow goes to investors, 12% to our company. In the scenario that we go ahead and return 100% of capital to our partners, then that split changes to 40-60. So that's that clause. In regards to the sale, as a 70-30, 70% to investors, 30% to our company, that remains consistent. So no matter what circumstance, if investors have capital in the deal or not, our investors will be receiving 70% of the profit from a sale.
Awesome. Well, I would say that is just about all the questions that came in. So again, we do truly appreciate everyone who was on. And then also this will be able to be, you can review this afterwards.
Yeah, there'll be a replay available. And additionally, I would say if you have any pending questions that we did not get to, and potentially we got some questions afterwards, we'll go ahead and try to address those directly. But if your question didn't get addressed, from our standpoint, we've got all questions here. But go ahead and email us at info@holdfolio.com. We'll address your question directly as soon as we can. Sterling, do you have anything else before we go?
No, I would say that's primarily it. And we do appreciate everyone, again, for taking time out of your busy schedules to join on this webinar. And then also we are looking forward to having those of you on board. We'll also, we're looking forward to have you on board on this specific investment. And then also we will be emailing you details on the next steps to take.
Yeah, thanks everyone. Have a great night. And like I said, email us with any additional questions. Look forward to it.